All right. Welcome, everybody. And as the title says, happy summer. It's Mark Yusko from Chapel Hill, sunny and hot Chapel Hill. And I actually am just back from the wilderness. On my third attempt, made it out to Yosemite. Man, what a place. And then watched a very cool movie called Yosemite Uprising, Valley Uprising, about the history of Yosemite. Very, very cool. So, and I will apologize up front. I made the mistake. You're not supposed to drink carbonated beverage before you talk, but I did. So my voice is going to sound a little scratchy here until I get it cleared. But around the world today, happy summer, a mid-year update on global markets. So we'll start with the taco truck, Trump with the Trump always chickens out trade that has been in full swing really since his pivot or his flip-flop, whatever you want to call it, in April, May. And he swapped the taco truck for the 4th of July pickup truck on the right, all-time highs. Forget about the bear market. Everything is Marvy. So it is truly a happy summer. And there we go. So sell in May and go away. Don't come back until St. Ledger Day. St. Ledger Day is the third leg of the British Triple Crown, usually that second week of September. So basically, it was an old adage that markets were pretty boring in the summer, so you could literally go away and not worry about it. Adopt the pace of nature. Her secret is patience, from Ralph Waldo Emerson. I felt a little bit about that out in the wilderness last week, following the John Muir Trail. Patience is really everything, particularly when it comes to investing. When there's nothing to do nothing. Pretty simple idea. And most of the return in investing comes from the waiting, not from the doing. The time of maximum pessimism is the best time to buy. The time of maximum optimism is the best time to sell, from Sir John Templeton. We'll talk about that here in a little bit. The only way you can bring the harvest in the fall is to plant in the spring and to water, weed, fertilize in the summer. So you actually do have to do a little bit of work if you want the big harvest. And this is probably the best time to do that watering and weeding, pull your weeds and water your flowers. The opposite of what most investors do. They tend to water their weeds and pull their flowers, which is not really a good strategy. I always tell people, if you're going to do anything new or innovative, you have to be willing to be misunderstood. If you're going to be prepared for winter, you have to buy your coat in the summer. From Jeff, who just got married in the summer out in Venice. So congrats to him. So just quick review of what we've been doing in and around the world so far this year. It's all been about tariffs, how it started, tariffs everywhere. Did anyone stop to think? And it was back to the rhyme of the Ancient Mariner, and that, Donald thinks trade wars are good and easy to win. He loves the word tariff. Well, he loves all words, but he likes to talk. One big tariff begets another and then another until you get a trade war. No one ever wins, and the customer gets, in a word, screwed. The benefits of tariffs are visible. People feel protected. What they don't realize is how many jobs get destroyed by those same tariffs. Protectionism is a misnomer. The only people protected by tariffs, quotas, and trade are those engaged in uneconomic and wasteful activity. It's a really important point. So it escalated, tariffs everywhere. The investment environment was starting to stink. By March, other countries were firing back, and we were in a full-blown trade war. And the bottom line is, Ronnie Reagan summed it up very well in 1987, saying, look, protecting American products and jobs, it sounds good. Homegrown industries then rely on government protection, and they stop competing. The problem is that higher and higher trade barriers, less and less competition, leads to a shrinkage of markets. Businesses collapse, industries shut down, and millions of people lose their jobs. So tariffs everywhere. Will the economy sink in April? Look, Adam Smith, the GOAT of economics, really said it best, that open and free markets are the best. You don't want to protect the monopolies at the expense of everybody else. So the resolution was hey, Trump caved, did the tariff on, tariff off thing, and she was pretty happy. Everybody was pretty happy in May. And bottom line was, she was right. There are no winners in tariff wars or trade wars. Bullying or hegemonism only lead to self-isolation. And the taco trade was just that. The Trump always chickens out. And that's how it went, right? The never-ending story, though, as we talked about last month, was, are these things really terminated? Are we going to stop talking about them? And, we talked about the never-ending story and how it just keeps going on. Well, as we talked about since February, tariffs are a tax. They reduce growth and prosperity. Trump, in his typical fashion, likes to escalate and take it or leave it, make ultimatums, and basically threaten. And then he always chickens out. So the taco trade was coined, and it had been pretty darn profitable since the big flip-flop in April. And the reason Trump always chickens out is because these tariffs would be the largest tax increase in actually decades. It's almost in history, but not quite. And it's a big issue. So, they talked about the never-ending story and that you're basically promoting lies often enough that they become the truth. And there was a little bit of that going on that, Trump was saying that there weren't going to be these big tariffs and he was going to back off, but he only backed off to the level that he said before the flip-flop, which was materially higher, would be the biggest tax increase in history, or second biggest in history. All that said, no one cared. And we were all cheering that it was lower than the 100% and 240%. Everything was great. So the problem was valuation. So we soared back to crazy valuations on the right, which only got crazier here in the last couple of weeks, which we'll talk about. And then we talked a little bit, it was just starting, the ultimate terminator of tariff trade wars is an actual hot war, or World War III. And Israel struck Iran, and then Iran struck back, and then the U.S. struck Iran, and everyone backed down. So it was pretty short, 12 days. Markets didn't like the no deal with China, so they rattled a few sabers and then declared peace, and market did react and went up a little bit. So we thought we were done with tariffs, but then yesterday he extended the deadline from July 9th to August 1st and put a bunch of more taco filling announcements, including big tariffs planned for South Korea and Brazil. Brazil just got hammered because of a copper tariff. So as we think about tariffs, they're going to likely end up significantly higher than people thought on the left-hand side. And the one, I guess, positive, if you want to call it positive, is they will generate government revenue. In fact, it would be the highest revenue ever, just law of large numbers, as much as $300 billion. But relative to the big, beautiful bill spending at $4 trillion, it wouldn't make a dent in the deficit. And so we'll still have the same problems we always had. All right. So back to global markets. So, we talked about in the surprises that we thought there was a possibility that we'd have the long-awaited recession. According to Polymarket, not so much. And if you look at global GDP since the negative print for Q1, there has been a pretty sharp rebound in GDP. Now, it kind of runs counter to the fact that the PMIs are still well below recession levels, and the new orders segment is even worse. So they're definitely in contraction. Job market has been deteriorating all year, and the ISM jobs is actually starting to look like the great financial crisis. And in fact, job numbers have been, this is the dirty little secret, they've been revised downward in 23 of the past 30 months. So the BLS, forget the L, the BS department basically says, hey, we created all these jobs. Well, the next month or the month after that, they say, oh, just kidding. So leading economic indicators have collapsed at a level we've only seen one other time in history, which was the global financial crisis. And we've now had the second longest streak of declines, again, in history. So that's bad. Loan delinquencies are rising, student loans in particular, because everyone basically not paid their student loans, and now they're just not gonna. And basically threatening to come, I don't know, do something. Auto loan delinquencies, though, rising as well, and credit scores are crashing. Now, the companies are the ones that feel the heat. The individual bankruptcies haven't really started yet, but corporate bankruptcies are on pace to be the highest level since the global financial crisis. So second surprise was that printer was coming, that the only way out for Jerome was, and everybody else in the world, was to print money, that everyone was just going to have to print money. And look, everyone's piling on Powell. Trump basically says the U.S. is booming, that, Powell's a terrible chair. He's got to go. There was a rumor last night that Powell had resigned. I still haven't seen any corroboration of that. Donald is saying that rates are at least 3% too high, calling for a 3% tax cut. A 3% rate cut. Now, let me get this straight. If the economy is booming and we're in this, best we've ever been, yada, 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 all his, all caps. If things are so perfect, why do you need a rate cut? No one cuts rates into a boom. That's actually not the way it works. You cut rates into depression and recession. I don't know. Despite the rumors of his resignation, Polymarket and basically everyone else, Powell's saying no cuts for you. So you can threaten me all you want, and you can leak rumors that I've resigned, and maybe he has since I've been working on slides, but I've seen no corroboration that he has. But there's not going to be a rate cut this month in July, and only a 50-50 chance in September. Now, despite all the rhetoric and no rate cuts, M2 just hit a new all-time high. So how's all this money being created? It's a part of the banking system, money creation. That is happening. And I'll show you another slide here in a second talking about how easy the environment is actually, despite all the rhetoric of being too tight. But the money supply growth is only 4.5%. Think about that. Only 4.5% a year, which means you're devaluing the currency 4.5% every single year. And that's below the rate at which it's quote unquote golden, meaning we don't see any meaningful inflation spurred. I'm not sure I agree with that, but that's what John Hopkins says. So here's the thing. If you devalue the currency 4.5% a year, then scarce assets, gold, Bitcoin, collectible Porsches, Pokemon cards, whatever, things that are scarce will rise in value. They won't increase, right? They won't get more efficient. They won't grow, but they will become more valuable because you'll need more dollars to buy them. So if you look at all of the nonsense about how terrible Jerome Powell is and how, tight the economy is and how restrictive policy is, and then you look at the facts don't support it. The facts actually say it's the easiest we've been since 2022, and we're starting to get back to levels of easiness that we saw during the QE era. It's kind of weird because the Fed's doing the opposite of QE. So why are things so easy? Well, because the swamp never got drained. This nonsense about drain the swamp, or get rid of the big spenders, and we're going to have Doge. It was all just kabuki theater. We now have the greatest spending bill in the history of spending bills. And, we all, I think most of us realize that, like Ronald Reagan, Donald Trump is not a Republican. He's never been a Republican. He's just not, right? He's always been a Democrat. He's always been a tax and spend, a debt-focused person in his life. So it's not surprising that under his leadership, just like under the Reagan leadership, we ended up with these big spending bills, despite the rhetoric that they were Republicans. So the government interest expense, it's at a level that is like Pandora's box. I mean, it's approaching the highest percentage of GDP ever, and it's estimated to blow right through that and become a very meaningful part of the budget. And how we fund it becomes increasingly worrisome. In fact, the only way we're going to fund it is by printing more dollars. So all that said, China makes the Fed look like an amateur. I mean, USM2 growth on my last chart looked kind of big until you put it up against the China M2 growth on the left. And at the end of the day, don't fade global money supply growth. So while I'm not really excited about a whole bunch of assets, which we'll talk about, I am logical in the sense that if you're going to devalue all the currencies in the world, then assets of all types are going to go up. Now, I tend to like the scarcest assets, and I think they'll go up the most. And the chart on the right is kind of Bitcoin versus global M2. So let's think about the other side of this, which is the bond side. So if interest rates are not going to get cut, then bonds should, in theory, be doing what they're doing, which is kind of just been stable. The 30-year bond has basically been flattish. Now, that's on the left-hand side. So yes, bonds are struggling. They're not going up. And yes, they did have their worst 10-year return ever. But the light at the end of the tunnel is that if you look at the right-hand chart, you've got the 10-year compound annual return of bonds, which just hit the worst ever, as bad as the 50s and 60s. But relative to equities, which have had nearly their best 10-year return in history, these alligator jaws, and you'll notice over time, the alligator jaws do not stay open, right? In 1958, it was a great time to go long bonds and short equities. And I'm not saying that necessarily tomorrow that's going to be the trade, but the likelihood that we're not going to get easier financial conditions and more money supply creation and ultimately lower interest rates and good returns for bonds, which will be challenging for equities, it's a pretty good bet. I mean, that's a pretty big alligator jaw on the right. So the last time global rates were at this particular level was literally right before the subprime crisis. And so if we look at total debt and we look at the type of debt and we look at things like car loans and credit card loans and all the stuff, the things that are subprime, the average auto loan rate is something in the teens, right? Not the average person, but the average loan. So there's a lot of stress in the system. And at some point, this increase in rates has to get reflected in valuation of equities. Now, that hasn't occurred yet because of all the money supply creation. But I'll show you a chart in a minute that shows maybe that's starting to go the other way. So, it's right here. The Fed has basically unwound about half of QE. So they've unwound half their balance sheet expansion that they created during QE. Now, the problem with it, it's all been at a massive loss. So they have literally lit about $200 billion, which is not chump change, on fire. But it's way worse, like orders of magnitude worse in the commercial banks. Now, the commercial banks are unrealized. The Fed is realized, and they just print more money to make up for it. But this portends a financial crisis. Now, again, I'm not saying it's going to happen tomorrow, but it definitely portends a meaningful crisis. All right, surprise number 3, the bear and the maiden fair. Bear market comes out of ICU and comes back. Oh, look, the bear was out of ICU literally for one day. For one day, the market was down 20%, a bear market. Taco, came to the rescue. Trump chickened out, and the market skyrocketed. Now, it skyrocketed in April and May, and it's been dead flat since May. So sell in May and go away and don't come back till St. Ledger Day might not be bad advice. So investors love tacos. And this was a historic rally in April and May. The question we asked last time, and I'll back up with some more data, was that is this reflexivity, meaning are the valuations high, right? The Wilshire 5000 in GDP has never been this overvalued, ever. Like not in 2000, not in 1929, not in 2020, not in 2024, never. And pension funds have never had a higher allocation to equities. So is it that the pension fund allocations are high because they're, supportive, or are they high because the prices went up? I don't know. It's probably a little bit of both. So everyone in the pool, it's summertime, it's hot. U.S. equities on record pace, could be the largest inflow to U.S. equities in history. And here's the craziest thing. The U.S. equity market is now larger at $64 trillion than all the other markets put together. So let that sink in for a second. Every other major market in the world, Europe, China, Japan, India, UK, France, Germany, Spain, all of it combined doesn't equal 64 trillion. That math doesn't math. So if long stocks is a good bet, leveraged long stocks must be better. So leveraged long ETF positions have quadrupled, actually almost quintupled, almost. And the leverage in terms of margin debt, I thought margin debt was bad in 2000. Looks comical. I thought it was bad in the global financial crisis. Again, looks comical. I thought it was bad in 2016 when we had the little, negative movement in oil prices from 100 to 26. But nothing compares to today. I mean, it's unfathomable how much money has been lent against stocks at current valuations. I mean, I probably get a text a day from somebody wanting to lend me money against my stocks, but it's crazy. So everybody loves stocks. NASDAQ surges, even small caps have gotten back to you. And look, remember, 46% of the index on the right don't make money. 46% of the companies in the Russell 2000 don't make any money. Yet the index recovered all their losses. So the EPS bar has been lowered. I love at the beginning of the year, everyone thinks you're going to make a lot of money. And then they just keep lowering it, lowering it, lowering it, lowering it. And then during earnings season, you get an 8% beat. That's just dumb. And I don't understand why people don't call them out. But like if you told me a year ago you're going to make 10 cents, and then you tell me you're going to make 5 cents, and you make 6, somehow that's a 20% beat? No, that's a 40% miss. But that's not the way the world works. So if you look at the 4 indicators of valuation on the left-hand side, the average of them is now the second worst in history and implies about a 58% downside to fair value. But as you see, we don't always stop at fair value. We go down to 1 standard deviation below fair value, which would be closer to a 70 some odd % decrease. I'm not saying that's going to happen, but at some point, remember, every day you spend above fair value, you got to spend a day below fair value. So at some point that does have to happen. On the right-hand side, other than a handful of months in history, we've just never seen PE ratios like this. I mean, and we got a lot of data since 1871, and the PE today is 40. And it with an inflation rate of 3, I'm 2.6, we should be closer to a PE in the mid-20s-ish, not 40. That's a long way down. So the equity risk premium is closing in on, the lowest ever. It was the lowest ever in the tech bubble. This is not quite that bad. On the right-hand side, we're now literally off the chart for Goldman Sachs. I mean, the range of historical outcomes of where the forward PE. So it's one thing to talk about the actual PE, right? The actual price to actual earnings. But this whole idea that, no, we'll look at the forward PE and then compare that to actual. Like, that's not the way it works. But the forward PE actually never happens because of this phenomenon, right? We lower the earnings because we're optimistic. So the forward PE is a meaningless number, and it's even off the charts. So I don't know what to think about that other than it's probably not going to stay there. So curiously, in the last 2 weeks, and it's only 2 weeks, so it's not really a big trend, but it's a big number. I mean, institutions have unwound about $7 billion. No, I'm sorry, $7 trillion. So that's a big number. And the long-short ratio is starting to get down to levels where shorts matter. So the shorts are back and institutions are lightening up. I'm sorry, 3 trillion, not 7 trillion, 3 trillion. So fourth surprise was MAG, stands for must acknowledge gravity. Now look, the hedge funds piled back into MAG 7 in May, and who could blame them, right? The returns had been awesome. The concentration is back to historic levels. In fact, the top 10 stocks have never been this concentrated. I love this chart. So on the left-hand side is companies are buying back stock at the fastest rate in history. Okay? Well, who are they buying them from? They're buying them from management. Management insider selling is at the 3rd or 4th highest level. So that seems like a conflict, if you ask me, but whatever. Retail investors, on the other hand, are in a feeding frenzy climax. I mean, they single-handedly bought the $3 billion that the institutions have sold, and they are YOLOing into meme stocks. I mean, Carvana, and I'll pick on Carvana later, but Carvana is drowning in debt, doesn't make money, will probably never make money, and survived a near-death experience. I mean, it went down 99% and is now up 10,000%. So it's a meme story for all times. But there's a lot of meme mania. I mean, there's this company, Hims, Palantir, Carvana, SoFi has become memeable, Netflix even. There's a lot of companies out there that are just crushing the S&P, which is not doing bad at about 10%. Palantir has become downright Tesla-esque. Now remember, Palantir went down about 80%. Well, it went up a lot and then it went down a lot. And now it's just been, like Tesla, just defying gravity. Carvana is the one that I just don't understand. It should have gone out of business. Equity should have been extinguished. The bondholders should have taken over, but they didn't. And if you held on at the 1%, down 99%, you've made a ton of money. Surprise number 5, DXY shrivels back to Bruce Banner form. Look, the U.S. dollar just had one of its worst 6-month periods in history, the worst since 1991, which was a long time ago. It is on pace to have its worst year in the modern era. So there were some worse periods in the 1800s, but not for a very, very long time. Now, Trump engineered the trade war last time, and the dollar strengthened. This time, it's not going so well. And he talks about wanting a strong dollar, but that isn't what we're getting. In fact, the dollar has given back all of the post-Trump bump, right? After he got elected, you can see the dollar surged through his inauguration and then has just collapsed and is now on the verge of a negative return for 10 years. In fact, only one other time has it been this far below its 200-day moving average over 2 decades ago. The one countervailing factoid is that everyone is short the dollar now. And usually when everybody's short, that's probably the end of the downdraft, at least in the short term. Now, the digital asset revolution, the question is, will it save the dollar? Most stable coins are US based, and the Genius Act, as the Donald in all caps again, is trying to make the US the digital asset capital of the world. I think it's a little hyperbolic, but it's a noble goal. It is true that 99% of stable coins in current form are backed by US dollars or treasuries. Now that could change over time, but it is a way to stem the erosion of, international payments, international credit, cross-border loans. All of that used to be hegemonic dollar-based, petrodollars, and all that's been under attack as the emerging markets rise and as China rises. So this actually is a pretty decent plan to save the dollar. Tether, right, largest producer of stablecoins, was the 7th largest buyer of treasuries last year and is on pace to pass Germany as one of the largest holders of U.S. treasuries. So maybe it's coincidence that Cantor Fitzgerald, Secretary of Commerce, happened to buy 5% of Tether right before all this stuff like the Genius Act started. Maybe it's not. The 2 biggest winners of the Genius bill are Coinbase and Circle. The they have been surging or surfing on stablecoins. Coinbase this afternoon hit a new all-time high at a $98 billion market cap. So the fact that we held on to some of that after the IPO is feeling pretty good. And Circle, I mean, we weren't involved in Circle, unfortunately, but on the digital side, but today is a $50 billion market cap. It's up, at one point was up eightfold off its IPO, which was only a month and a half ago. I mean, we're not talking a long time ago. So it was an 8-bagger. Now it's only about a 5.5-bagger or 6.5-bagger, sorry. So House of Black and White, look, Saudi needs oil prices higher. We thought that they could go higher. They were going the wrong direction right through the taco chicken out. And they have been going the right way since. Now, they went down a little bit during the strife around the war, when the war ended. But again, it was only 12 days. But now we're at this really interesting junction where if we get through the 200-day moving average, there's pretty good upside for oil. Oil stocks absolutely bottomed, and we talked about that multiple times on the flip-flop, and now have indeed passed the 200-day moving average and look pretty good. Oil services still have to take out the 200-day to really have a breakout. MLPs, double-digit total return, only up about 5%. But remember, you're getting about an 8% yield, so still looks pretty good. Europe shouldn't outperform, but Crazy Christine was going to outcut everybody and make them. Mission accomplished. I have to give her credit where credit is due. Look, they got whacked on Liberation Day just like everybody else, but on the flip-flop, they have been en fuego. I mean, up 4 or 5 times as much as U.S. stocks, and European financials have just been completely on fire. So I'll bet most people didn't have peripheral Europe as the best performing markets in 25. I'm willing to take that bet. Greece, Spain, and Italy crushing everybody else, and Europe crushing the U.S. So Japan, they need Ueda-san to stop being a hawk on the yen. For the first part of the year, he was way too hawkish and Japanese equities collapsed. He changed his mind, maybe. And since then, we saw a actually record 2-week gain. And since then, to update the slide, the yen has quietly been weakening, and Japanese equities have continued to break out. So that is pretty simple. I mean, it's Abenomics 101. Weaken the yen, Japanese stocks will go up. Just as a reminder, again, we think the Fed is good at printing money. We think, China is good at printing money. No one prints money like Japan. Japan is the poster child for what happens when you over-financialize an economy. When you get too far in debt and the Bank of Japan has to buy all your bonds and your ETFs, and basically you financialize the economy by printing yen. Gold in yen is, that is a rocket ship ride. So it's a reminder that when you live in a place where governments can print, you need to own things that can't be printed. So gold is one of those things. The Dragon and the Wolf, Shanghai Index continues to fly despite all the rhetoric about tariffs. Look, trade war has been volatile. China got hit on Liberation Day just like everybody else, but has fought back valiantly, is now materially up about 3 times as much as the S&P, both traditional stocks, MCHI on the left and KWEB on the right. A shares have broken out. Now, they're not up a lot because they went down more, but they have broken out of this wedge on the right-hand side, and they look to be very interesting. I think China is trying to enrich the middle class, and a lot of them own the A shares. So I think that's a pretty good play. If you look at Chinese equities, yes, they've been volatile, but BABA, KWEB, MCHI, Pinduoduo, Baidu, all have outperformed the S&P. Only JD has really been the laggard, and that's because PDD has taken share. The big surprise in 2025 for Bitcoin will be that it gets to 150, fine, but that it actually goes down again. Now I'm a lone wolf on this call, and people don't like it. And so far, everybody's just bullish, right? This is Michael's 21 mantras for 21 truths about Bitcoin. I think they're all absolutely true and important. Bitcoin adoption following the S-curve of the internet, almost in lockstep, and we are so early, so early. Bitcoin looks big, just past Google, to be now the 6th largest asset in the world. So let that sink in for a second. It's a 15-year-old asset that is now the 6th largest in the world. But when you compare it to total global assets at 1,000 trillion or a quadrillion, it's pretty small. And it's probably going to come for the king. In fact, Bitcoin ETFs at 150 billion are indeed taking aim at the king. The gold ETF is clearly in their sights, and it's happened much, much, much faster. So, look, Bitcoin hit a new all-time high earlier today. I don't know if it's still there, but firmly back to a double-digit gain. We hit $113,000 per Bitcoin, up 21% for the year, well ahead of most assets. The correlation with global M2 on a lag is really high. Again, I'm not a statistician, but that's, high 90s. And offset by 84 days. Why 84 instead of 90? It doesn't really matter. Call it 90, call it 84. Yeah, there's some curve fitting in there, but that's the whole point. You're trying to figure out the model that works best. Well, the power law says late this year, November-ish, we hit 200K. And yeah, then we have a bear market. But this bear market will likely be less bad than the others. This one's predicting 50%. That would be less bad than the last, 84, 72. So the halving cycle theory says we peak at 180. And when you do a true log scale, it doesn't look as parabolic and as volatile. It just looks like straight line adoption. It's kind of interesting. So some are arguing that the retail FOMO cycle, which caused the 17 cycle and the 21 cycle and the 13 cycle, is now gone. Well, if you look at Google searches, it's kind of true. No one's really thinking about it. Maybe institutional demand and nation state adoption means we're now in a different regime. It's possible, certainly possible. If you like technical patterns, whichever one you like, head and shoulders, cup and handle, it's all saying we're going much higher, probably 150 to 180 this year. There are 100, actually over 100 now, 137 or 8 firms that have put Bitcoin on their balance sheet. A handful of them are Bitcoin treasury companies. Highlighted here, Metaplanet has now crept up to number 5. Full disclosure, I'm a board member of Metaplanet and meaningful owner. Pomp did a new Bitcoin treasury company called ProCap. I'm also potentially going to be a board member of that. ProCap is a SPAC, CCCM. That hasn't closed yet, but they've already bought almost 5,000 Bitcoin and moved up the cap table. And then Jack, who is our Strike CEO, is up there at number 3 at 21 Capital, although we don't have a piece of that. Bitcoin treasury companies follow a very standard path from upper right, highly volatile, to very stable. So the law of large numbers starts to kick in. And so you kind of want to buy them when they are really volatile and they're acquiring lots of Bitcoin. And then you want to hold them as they ride down the path to stability. Now, it doesn't mean you don't want to own something like MicroStrategy. It's just, it's not going to be a big gainer, but it's going to be a leveraged play on Bitcoin. So I think it will outperform Bitcoin. So if you like Bitcoin, you could own some MicroStrategy too. And there's a bunch of other companies in there that they're moving down that path. Top Bitcoin obviously is Strategy now, Strategy B. Crushed all of traditional finance over the past year, despite everyone saying it's overvalued and it can't keep going. They just keep going. Over $100 billion market cap, probably on its way to $1 trillion. Look, Saylor has created the full spectrum Bitcoin capital market solution. So if you want preferred stock, if you want common equity, if you want convertible bonds, all of which backed by pristine collateral of Bitcoin, he's your guy. Metaplanet running that MicroStrategy playbook to perfection. Best performing equity in the world in 2024, best performing equity in Japan this year by an order of magnitude of 10 times. Gold still wears the crown. Look, everybody likes to buy what they wish they would have bought. Gold was consolidating. It might be breaking down. The fact that it broke down below the lower part of the triangle is not a good sign. Sorry, Peter Schiff. Investors piled in. They probably piled in too late, but they did at least discover the gold miners, and gold miners have been completely crushing it this year, and they should. Their revenue growth is now approaching the highest in history, and their free cash flow generation is literally at the highest level in history. And they're now trading back at parity, the blue line on the right, with free cash flow. They normally trade around a 40% on average premium. So there's still room for gold miners. Now, Trump made a surprise announcement of copper tariffs. I mean, literally, this came out of nowhere. And copper prices had the craziest day in their history. I mean, literally, people were caught completely off guard. Well, not everybody. Somebody, not pointing fingers at anybody, because I don't know who it is, but somebody absolutely knew before the announcement and took some big positions. The stocks jumped less, which I guess makes sense than the futures, because I think people think he's going to taco on this too and chicken out, but we'll see. All right. So latest podcast on Around the World is The Never-Ending Story. It will be replaced later today with this one. Corey has been running around working hard, so we're overdue to update on the Hedged with a D. And then every week we do the digital currents. X and I, we didn't do it last week because we were on vacation. So we swapped in Corey talking about stablecoins. This is a must listen episode to learn about stablecoins and the Genius Act. Books to read about the digital age and private credit. All right, they're good. So private credit, I don't dislike private credit generally. The problem I have with private credit is oftentimes you're taking equity-like risk and getting bond-like compensation, because the people that need private credit are the people who can't get financed in the normal public credit markets. So they can't issue any more bonds. They have low credit ratings. So it's kind of like the dent and scratch items. You get a lower price, but there's more risk. So private credit, generally speaking, isn't bad. I think it became a mania over the last few years, and when you're only getting paid 6-7% for private credit, that's probably not a good trade. But like anything else, the credit is always dependent on the issuer and the collateral and the type of assets behind it. And there are some good private credit offerings and there are some bad private credit offerings. I think generally speaking, you just got to follow the spread. If the spread is high, then it's attractive. If the spread is low, it's not very attractive. Besides gold, miners, and Bitcoin, what else do you buy as protection? Great question. So I think stuff, right? So any commodity, any scarce commodity, can also be good protection. Scarce real estate, right? Real estate where they can't make more immediately, like maybe not multifamily units, because it seems like they can throw those up anywhere, anytime, and there's a lot of them. But, well-positioned, grocery anchored strip malls, those seem to be pretty good. Industrial warehouses seem to be pretty good. Office buildings, not so much. So I think there's some real estate that's interesting. Cash is always a great protection. The problem with cash, right, is that you're losing value every day. So you're better off in things like Bitcoin or gold. So it's kind of an oxymoron to say I like cash. Although cash is super, super liquid. Like sometimes Bitcoin's a hassle to get to, or sometimes gold can be a hassle to get to. Cash allows you to act quickly when it's time to act. So I don't hate cash for short periods of time. Yeah, I mean, I actually really like the Bitcoin treasury companies. I think you're getting the best in pristine collateral with the upside of the arbitrage as they can issue new shares at a premium and buy more Bitcoin. So there's a flywheel mechanism. Now you got to watch the MNAV ratio and be cautious about when you enter and exit or just hold for a long time. But those are good ones. View on Solana. We still like Solana. I think in the partnership, there's a couple of us that like it more than others. And we did the Upexi deal, which has been volatile, but I think will turn out to be a pretty good one in the sense that, Bitcoin treasury is pretty cut and dry. Digital gold, you issue at a premium to NAV and you buy more Bitcoin. It's just a beautiful thing. The difference with a Solana treasury company or an Ethereum treasury company is this idea that you can somehow, stake your coins and make money and kind of have a business model behind it, which I think is legit. But I do think there's one challenge to that, which is when stocks trade on story, they tend to get a higher multiple than when they trade on the underlying business. So let's take Strategy. When Strategy was MicroStrategy and it was a software business, it didn't really trade at a big premium to its Bitcoin holdings because people are like, oh, it's just a software company. Well, now the software company is like a rounding error. It trades on the story of being a Bitcoin treasury company. So I think the same is true here, is if you overemphasize the business aspect of Solana and staking, maybe you get a lower MNAV and so than you would if you just did the story. All that said, I think Solana is in an interesting battle with Ethereum. Ethereum has a much bigger installed base, still has worse gas fees. Solana is faster and cheaper. There is more development on it now these days. And like long term, if I were a betting man, I probably would bet on Solana over Ethereum, although the ETH heads don't like when I say that. But so that's a long-winded way of saying I think Solana is going to be volatile, but probably is going to continue to take share over time. If you miss an episode, where are replays? So around the world, we have a YouTube channel, Around the World the USCO. So there's all of our historical ones there. For Digital Currents, we also have a YouTube channel, as well as I think we post links to the website. And we don't post the slides on the website, but if you send an email to, and there's a reason for that, I'll explain. If you send an email to ir@morgancreekcap.com or evrana, E-V-R-A-N-A, or L. Jacob, Leslie Jacob, at morgancreekcap.com, we can get you the slides. The reason is Microsoft a few years ago did something weird. So my slides used to be, 10 gig, 15 gig, and they suddenly ballooned to like 120 gig. And most email systems can't handle that. So we send a downloadable link rather than post them anywhere. So what valuation I think Gemini lists, I don't know. They're in their quiet period. They have filed their S1. So, we don't really have any great insight there. There are lots of rumors out there, but don't really know. My guess is they'll be pushing for something similar to eToro. I think they've got similar metrics as eToro, but don't know. What to expect on inflation? Inflation, I think inflation is higher than the numbers they report because they're being goosed by owner's equivalent rent, goosed down by owner's equivalent rent, and oil prices. Now, oil prices, I think, could start back up, which that would be bad for inflation. I think generally inflation these days is less about supply and demand of goods and services and more about dollar devaluation. And given how loose the Fed is right now, and given how fast money supply growth is accelerating, I would expect that to be less good for inflation. All that said, I don't think we're going to hyperinflation or anything like the 70s. I just think it's probably going to be stubbornly above the 2% threshold. Now, the 2% threshold is a dumb threshold anyway, right? There shouldn't be inflation. That's just theft. But it's a long-winded way of saying, I think if you look at inflation expectations, they have come down a little bit, but they're still stubbornly above 2. Demographics would argue for basically no inflation because demographics are so bad. Working age population growth is collapsing. Productivity is actually collapsing despite all the nonsense about AI is going to increase it. I shouldn't say nonsense, but all the claims, hyperinflated claims, but the actual data is not really going up. So inflation should lean more towards deflation, kind of like Japan went through for the last 20 years. And remember, Japan's 11 years ahead of the U.S. demographically. So anything that happened to them 11 years ago is where we should be. Just kind of right. So I'd lean more deflationary, but I think the lockdown money supply creation, remember 80% of all the dollars in the history of the dollar were created in the last 5 years. It's a crazy stat. That unwinding that is going to, I think, be more challenging than they thought. And I think ultimately the Fed's going to have to give in and cut because everyone else is. And that would counter the deflationary forces of demographics. So that's moderate inflation would be my guess. Your expectation for yields. So yes, you can get a copy of the slides. So I said, just send an email to IR or L. Jacob or Evrana at morgancreekcap.com. We'll get you the slides. And, I think yields are going to be stubbornly high for a while, unless while I was doing this call, they fired Powell. I don't think Trump's going to get his emergency rate cut. Now, things could change. We're coming up on the Grand Tetons. Wherever, Wyoming. Can't think of the name of the town for some reason. Just totally went blank. But we're coming up on the big meeting out there in Wyoming, and all the heads of state. All the heads of the central banks are going to be there. And is it possible they change their tune, as they are prone to do when they go out there? Yeah, that's certainly possible. And then I would think yields would head down. What about the efforts to duplicate the strategy, Bitcoin strategy with Ethereum? So Ethereum, there are a handful. I think there's 4-ish. There might be a couple more companies that are trying to do the same kind of Bitcoin treasury strategy, but with Ethereum, just like there's 4 or 5 that are trying to do it with Solana. My personal opinion is that Ethereum and Solana are not as well suited for the treasury idea, but there are other opinions on it. I had a conversation with a friend, good spirited conversation with a friend who's a portfolio manager, and he thinks the other way. He thinks that because you get the yield component from staking, that Ethereum and Solana are better suited. So he actually owns in his ETF a little bit of the Sol and ETH. Look, I think Joe Lubin's a really smart guy. I probably wouldn't bet against him that often. So looks like you're predicting repricing of equities. If so, what will be the catalyst? And will BTC also decline in lockstep? Again, great question. So it's funny. I want to, with all my logic, absolutely predict a repricing of equities. But every time I've done that in the past, in these situations where I just look at the data, it doesn't happen, right? We've been in this buy the dip mentality really since 2010, 2009. And every time I think things can't get more expensive, they do. Every time I think we're going to have a meaningful correction, we don't. And so I just figure people get tired of crying wolf. So I'm trying to soft pedal it by just putting out facts, right? We are at the second highest valuation level in history on every metric. There's not a single one that, and actually a couple of metrics were at the highest we've ever been. Now, how long can you stay there? Well, again, there are no charts of permanently higher plateaus. They all eventually peak out and go the other way. So, what's the catalyst? That's the great question there. What's the catalyst? The catalyst is likely a non-taco, right? Trump doesn't chicken out. And we get tariffs that disrupt global trade, and that would be bad for global growth and profits. So that would be one catalyst. Second would be a global financial crisis type event with subprime auto or student loans or credit cards or something like that, like subprime. I'm less worried about that because it's funny. If you inflate the value of assets faster than you inflate the amount of debt, then the debt to asset ratio actually goes down. So when you look at, yes, people have a lot of debt. We have record credit card debt, record student loan debt, record auto debt. But because people's homes are worth more and because their 401k is worth more, we actually have one of the lower total household debt to asset ratios that we've had in the last 50 or 60 years. So, bravo to the powers that be. The fact that, it costs you $35 to go to lunch by yourself sometimes is crazy, but, that's a different story. So I don't think we're going to get a global financial crisis kind of catalyst anytime soon. So I think the more likely catalyst is we don't chicken out from tariffs and you get a global trade disruption. Will Bitcoin drop in lockstep? I don't think so. I think there's far less leverage in the Bitcoin system. There's a lot of leverage in equities. And so equities could fall really hard, really fast if they started to unwind. I'm not saying they're going to, but they could. The difference this time is, well, that's not true. In that scenario, if there was an unwinding of margin debt and everybody got margin called on their NVIDIA calls or whatever, yes, you would have a drawdown in gold and Bitcoin and bonds in the short term. But I think it would be very short-lived. It would be very similar, I think, to what happened in 2020, right? Bitcoin went down in lockstep with all the markets when lockdowns happened, but then Bitcoin rallied significantly, right? Bitcoin got down to $5,000 in 2020. Now it's $113,000. I mean, it's crazy. So that I just think there's not as much leverage and not as much crazy leverage like there was in the last cycles, which goes to that one chart about the change from retail FOMO to institutional demand. The institutions are much more sober. They don't put as much leverage on. So that's a great question. Will Figure go public this year? Again, they're in the quiet period. I think so. I mean, that's what Mike wants to do, but they're in the quiet period and they have filed their S1. So not much else I can talk about. Stable coins. I use USDC. I've never used Tether. I'm not saying I'm a Tether truther and I'm not averse to Tether, but I always just use USDC. That's just been my one of choice. I'm sure there are other good ones out there. GUSD, the Gemini stablecoin, is a good one. It's smaller, and I just happen to use. I have more at Coinbase than I do at Gemini, so I've been more likely to use USDC. Backdrop: how much international equity do you feel investors should have? Yeah, look, again, great question. So one of the interesting things about investing globally is if you constantly buy the index and you look back 10 years later, 20 years later, you ended up with the wrong allocations at the wrong time. And that makes sense, right? If you go back to 1900, the UK was the biggest market. The US was an emerging market. And if you would have bought the index in 1900, you would have bought lots of UK stocks, and that would have been the wrong trade. You should have bought the upstart, emerging market, the US. If you would have bought the index in 1989, you would have bought a lot of Japanese stocks, and that would have been the wrong time to buy them. So now I would have said the same thing 5 years ago, and I probably would have said the same thing, honestly, 10 years ago, and I would have been wrong, because one of the things that has changed is the predominance of rules-based automatic investing and passive. So basically 401ks, 403bs, and index funds. And so every 2 weeks, the money just goes in and it has to buy the US, even though the US is 70%, which makes no sense because it's not 70% of global GDP. So at some point, I think that shifts. I would, and I do for myself, constantly rebalance back toward international markets. So, I think Japan is like a 3 or 4% weight in MSCI World, I think you should have 2 or 3 times that. I think China's like a 3% weighting. I think you should have more than that. Europe is like 13% weighting, something like that. I think you should have more than that. That means you have to have less US, which means you have to have less Mag 7, and that's painful for a lot of people. But I'm probably of the 50-50. Global is better than 75-25, meaning US versus rest of the world. Real estate, look, I don't hate real estate. I think the challenge for real estate is sector by sector. You got to be very careful. Like I wouldn't touch office real estate, but medical office, geez, if you go anywhere these days, that's all they're building. So I think medical office is really interesting. I think logistics is really interesting. E-commerce continues to be a big deal. Apartments, I don't really love those. The thing about real estate is it can be a scarce asset in certain places, beach real estate, mountain real estate. The lodge inside Yosemite, very valuable piece of real estate because you can't make more. The other thing about real estate is, like other scarce assets, it's not priced in real estate, it's priced in dollars. So as the dollar continues to devalue, real estate's going to go up. The negative for real estate is that if my choice is real estate versus a tokenized asset, my tokenized asset doesn't require, getting fixed up. If your gutters leak or your house needs to get painted or, your mall needs to new facelift or new parking lot. So they don't have the same cash flow requirements. So tokenized assets to me have a little better advantage versus real estate. I'll show why I think they'll take share as store of value. Uranium plays. I'm not really up to date on uranium, James. I don't understand. Well, I do understand why, everyone doesn't like nuclear. I like nuclear. I think it's really clean energy. It's sufficient. China's building lots of it. But I think uranium's become easier to mine. So I just think it's been tougher to make money in that space. Views on Tesla. I don't like Tesla. I think the company's good. I think the car is actually better than I thought. I just think it's overvalued. I think it's always been overvalued, but he's the master of short squeezes, so I wouldn't bet against him. And I learned my lesson a long time ago not to short it. But I don't really love it. I don't own it. Why not start a fund buying? Yes, we should. We should have. UTXO, the Bitcoin guys have crushed it in this regard. We talked about it. We didn't do it. We should have done it. And there's, Pantera's now doing it, so they're going to jump in. There's probably still time, and thank you for bringing that up because we should do it. Should definitely do it. Because we can get access to the companies when they're private, and then there's an arbitrage there. So it would be good just to have a public one too. But Jackson Hole, thank you, Gerard. God, I could not remember that to save my life. Because it's too cold to ski there. Bitcoin miners definitely gone up. Riot and Masa, whole Bitcoin. Yeah, so Bitcoin miners, look, the core business of a Bitcoin miner is a challenging business to make a lot of money because your mining rigs do wear out and depreciate. But if you have good power costs, given how high the price of Bitcoin has gone, if you can generate a Bitcoin at 25 or 30K and sell it at 108K, you can make a lot of money. So I think those stocks have become better. They're also diversifying in many cases into other high performance computing. So that's good for them. The big challenge is the decision to hold your Bitcoin or sell it, because if you hold it and it appreciates, that's really good for you. And then you kind of have a Bitcoin treasury company feel to you. But at the end of the day, you got to pay your electricity bills. So some of them can issue debt, and that's not a bad play. I think it's pretty good play. And now you're seeing, CoreWeave going in and buying Core Scientific. That's a great play for them because they're their largest customer. So very smart move. And arbitrage a couple $2 billion in doing it. So I think that's another thing that could happen is you could see these miners get sopped up by bigger companies. But interesting. All right. I should oh man, I thanks for all the questions. That was awesome. And I appreciate reminding me on Jackson Hole. I could not remember that. So again, wish everybody happy summer. We'll be back towards the end of summer, towards Labor Day or St. Ledger Day, and with Around the World. And hope everybody enjoys their vacations and stay safe and sane and cool. Talk to you soon.